Okay, dear PM students, performance management students, let's discuss this question on variance analysis. And this question is from Study Hub. What was the direct labor rate variance for the last month? Okay, they're asking us calculate direct labor rate variance. Actually, direct labor rate variance is the difference of, you can say, two rates. One is the standard rate of the labor per hour, and second is the actual rate of the labor per hour. If your standard rate is higher than the actual rate, then variance is going to be favorable. Means you spend less than what standard told you. You spend less than that. But if your actual rate is more than the standard rate, then obviously variance is going to be adverse. So let's attempt the question. A company operating a standard costing system has direct labor standard per unit of one of its product 4 hours at 12.5 per hour. Last month, 2195 units of the product were manufactured. The actual direct labor cost, actually, labor has worked 9,200 hours, and this is what company has paid. If I calculate actual labor rate per hour, so 1,10,750 divided by 9,200, this will give us the actual rate per labor hour. 110,750 divided by 9,200. I'm getting students 12.0380 something. So you can see one thing. Actual labor rate per hour is lower than the standard rate. So it means whatever the variance comes is going to be favorable, because we are spending less than what is as compared to the standard. Actual we have spent on direct labor less than that. So variance is favorable. So simply labor rate variance is equal to actual hours. We have 9,200 into standard rate is 12.5, but actual rate is less than that. So simply 12.5, so multiply this 9,200. I'm getting 4250 favorable. There's another way of around also is available to deal with the same question. What is that? Just compare actual labor cost with the labor cost according to the standard. If your actual labor cost is less than the labor cost according to the standard, the variance is simply favorable. Here, actual cost, we know that it is 1,10,750. This is actual cost of the labor. Now let's see according to the standard what cost should have been. 9,200 hours labor they have actually worked. According to the standard, one labor hour rate should be 12.5. It means 9,200 multiplied by 12.5. Let's see according to the standard what should be the cost of the labor. It should be 1,15,000. Now look at this. Your actual cost is less than the cost according to the standard. So obviously the variance is favorable. You can see the difference of these two. Definitely we get the same amount, 4250 favorable. So obviously it is up to you how you solve the question. So main concept is very simple. If your actual labor cost is less than the cost which should have been according to the standard, then your labor rate variance is favorable. And one thing, let me repeat one announcement for you again, that for June 2026, ACCA students, Abilu School of Accountancy is offering a live online crash course, and we will be revising the entire, I would say, PM. And in that crash course, the good part is we will be discussing all the questions from Study Hub. So questions, either mainly the questions will be from Study Hub, and the second area from where we are going to take the question, they will be from the pre-seen mock. So that is all about today's class. Thank you very much for watching this lecture.